Welcome to Cashflow Tribe's Masterclass. Please remember to turn off your phone and any other distractions. Pay attention and, most importantly, have fun. Before we begin, here's a quick disclaimer. Ben Murison, Matt McKeever, and Cashflow Tribe Incorporated discussed today is the personal and sole opinion of Ben Murison and Matt McKeever based on observations of the real estate market. It is in no way to be considered as legal and financial planning advice. Before any consideration is given to a real estate investment strategy, do not invest on this information without first consulting with a licensed attorney, properly accredited in the jurisdiction, and having expert knowledge in the practice of real estate. Real estate or private mortgage investing should never be considered until after you have consulted with both legal and financial professionals who understand the risks and can advise you properly. This message is in no way a solicitation for financing transaction with Ben Murison or Matt McKeever, or any of his affiliates, corporate or otherwise, but again, should be viewed as only points of discussion and consideration with your own professional advisors.
Hey everyone, how's it going? Matt McKeever here. So we're currently live streaming on Easy Webinar, the Facebook free beta group for Cashflow Tribe, as well as my YouTube channel. So really excited every single day this week. We've been doing the live training and we're going to continue all the way to Sunday. So we're just kind of giving you guys a sampling, of what you can expect if you were to join the Cashflow Tribe Alpha family in full. But again, we really just want to provide value. So that's what this live stream is all about. So I'm going to pull up my slides right now on this topic where we're just going to be kind of discussing real estate investing basics and specifically looking at why do people invest in real estate in the first place? Why are so many investors and aspiring investors attracted to real estate investing, and really just dial this in. So if you're brand new to the idea of real estate investing, this is definitely the class for you. If you've kind of been there, done that, well, this is going to be a good refresher. And in fact, I think near the end, I might even give you some more food for thought that might make you even love real estate more than you already do as an investor. So appreciate all of you guys jumping in the comment section. If you can hear and see me, just give me a thumbs up. Really appreciate that, just to make sure that everyone can see and hear me on this live stream. Same with those of you on Facebook. Go ahead, leave me a thumbs up, or we can hear you, Matt. And of course, YouTube, I didn't forget about you either. Give me a little thumbs up there. All right, so let's dive into it. Why is everyone so obsessed about investing in real estate? Well, in this lesson, what I'm really going to be focusing on and what we're going to be discussing is real estate's proven business model, why having control over the asset is so important, and why that really separates real estate from a lot of the other investment strategies out there and the other investment vehicles available to us. Then we're going to discuss the power of leverage, one of my favorite subject matters, and definitely an area that a lot of Canadians and just people in general have misunderstandings and a lot of limiting beliefs and fears around. And then finally, we're also going to be talking about real estate versus other investment vehicles like real estate versus stocks. That's probably the most common one that you're going to see, whether it be discussed in some deep subreddit or whether it be in a newspaper article or even just, a friendly YouTuber chatting about it. So let's talk about how real estate's a proven business model and why that kind of gives me, at least personally as a real estate investor, a great sleep at night factor. So here we've got just a little breakdown of Maslow's hierarchy of needs. So if you guys aren't familiar with this is really about, that it's usually presented as a pyramid or a triangle. And at the bottom, the base level is really just our physiological needs. So that's like food, shelter, air, water, being able to get sleep, having clothing, protection from the elements. That's really what the physiological needs are all about. But once that's kind of covered, then we move further up into safety needs, then love and belonging, esteem, and then finally self-actualization. And so this is one, if you've never been exposed to this before, you should definitely do a little bit more research and get better understanding of this. But specifically, the reason why I'm showcasing it on tonight's webinar is real estate investing, being a landlord, we're really providing, that base level need. So this is something that every single person needs, regardless of where they're at in their current journey. They need some sort of shelter from the elements. And so because of that, it also means that real estate, it's a business that's been around for quite a while. So real estate's one of the oldest businesses. And so we're just going to break down real high level here. Capitalism is an economic system based on the private ownership of the means of production and their operation for profits. Characteristics central to capitalism include private property, capital accumulation, wage labor, voluntary exchange, a price system, and competitive markets. And so real estate is one of the primary inputs for the means of production. Whether we're talking about it in, abstract concepts, or whether we're talking about like real specific, like, hey, if you're going to have a factory, that factory needs to be built somewhere. It needs to be on some sort of land. And in fact, a lot of companies aren't even going to necessarily own the building or the land. They're just going to own the patent or the machinery inside of that factory, and they're going to lease or rent the building. So again, real estate is really just a piece of this capitalism economic system that we know and love here in the 21st century. Realistically, at this point in time, it seems like a no-brainer to me that we've proven which economic system is the best currently available to all human beings. But I do know that that's still up for debate in some people's minds. But realistically, in any capitalist society, one of the primary inputs in regards to the means of production is going to be real estate, is going to be land. And then in addition to that, we also have the buildings that land is on. I really like Ben's buddy, Dan, who's the Lambo Lapdog on Instagram. He's been crushing it for a really long time, both as an entrepreneur and a real estate investor. He's got over $30 million in real estate investments currently. And he likes to keep it really simple when he's talking about real estate investing. He describes it as boxes on land. And realistically, a lot of us, we want to overcomplicate the process. We really want to, try and figure out the best corporate structure, this, that, or the other. But at the end of the day, that's what we're providing. We're providing shelter. We're providing a box on land as a landlord. Whether you're in the industrial, commercial, or residential real estate space, that's what we're all doing as landlords. So again, just kind of going down a little bit of memory lane here with some historic examples. But the reason I wanted to highlight this is like being a landlord, it's one of the beginning business models. Really, the idea of renting out a spare room, being an innkeeper, a hotel, a motel, or just a landlord with an apartment or a flat available for rent. So, in ancient Rome, the insulae were large apartment buildings where the lower and middle class of Romans, the plebs, dwelled. The floor at ground level was used for tabernas and shops and businesses, with living space on the higher floors. And in Rome and other imperial cities, these reached up to 10 or more stories. So the idea of apartment buildings, of these boxes on land with multiple units available for rent, it's been around for quite a while. I got a feeling it's going to be around for quite a while still. And then we've also got the Puebloan peoples, I probably mispronounced that terribly, of what is now the southwestern United States, have constructed large multi-room dwellings, some comprising more than 900 rooms since the 10th century. So again, this idea of a lot of different people living under the same roof, been around for a really long time. And the reason I think this is important to highlight is, especially in the 21st century, we're constantly hearing about these different ideas and concepts, and hearing about businesses and industries, I should say, being disrupted because of technology. Will real estate or being a landlord be disrupted because of technology? Quite possibly. But at the same time, I think the overall principle of being a landlord, of providing shelter, well, this is actually here to stay. So again, we truly are satisfying a need of everyone by providing them shelter. That's that physiological need. So everyone, regardless of how evolved they are on Maslow's hierarchy of needs, they still need that base rung to be covered, or else they can't move past onto safety, love, esteem, and self-actualization. So the other thing that we really need to remind ourselves, if we're thinking about real estate investing, or if you're being challenged by maybe friends or family that have good intentions, but are probably bringing drama and not data to the equation or to the discussion, is a lot of millionaires are made through real estate. So here's a quote that's commonly attributed to Andrew Carnegie. I don't really know if this 90% of all millionaires become so through owning real estate. More money has been made in real estate than in all other industrial investments combined. The wise young man or wage earner of today invests his money in real estate. No idea if that's factually correct. I don't think it actually matters. I think what we can take away from this is we all know of individuals that have become successful because of real estate investing. We probably all are 1 or 2 degrees of separation at most from someone that's actively building up a large real estate portfolio. And even just, anecdotally speaking, when I was working as a public CPA and doing taxes for high net worth clients, I noticed a very consistent pattern. It didn't matter whether the person was making their active income from real estate investing or whether they were a doctor, lawyer, accountant, or, an engineer or any other sort of high paying profession. A lot of them would then take that money and bring it over into real estate and start investing into real estate at some point or another. And there's a multitude of reasons that they do that. But I think a big part of it is real estate's very tactile. So it's very easy for us to understand a real estate investment because like we can feel and touch it, we can sleep in it. And there's just a lot of benefits to owning real estate that I think paper assets can't compete with. And we'll get into that in a little bit on tonight's webinar. But I really just want to hit home that, being a landlord, providing shelter, it's been around for a really long time. I suspect it's going to continue to be around for a really long time, at least until we can upload our consciousness to the cloud or something of that nature. So let's not overcomplicate. Way too often I find people talking about how this, that, or the other technology is going to dramatically disrupt real estate investing. Now, what we need to understand is real estate doesn't exist in a vacuum. In fact, there's a lot of rules and regulations around providing shelter. So in my home market of London, Ontario, we literally have to have a license as a landlord. And this is actually becoming more and more commonplace in a lot of markets. Now, regardless of whether that's right, wrong, or we have our own opinions, it's the nature of reality. And what that means is, it means that, a technology that potentially could disrupt this industry is going to be slower to be implemented because of those barriers to entry. As well, when it comes to, the idea of 3D printing houses or different things of that nature, again, that technology may come and that may be an interesting disruptor to this space, but the actual application and rollout of it, what we need to understand is like, have you guys have heard of NIMBYism? So that's the not in my backyard people. Those are the people that, want to keep a high rise from being built in downtown London, Ontario, or the people that don't like affordable housing units being built in their subdivision. There's a lot of people that want to tell other people how to use their land and what they can and can't do with that land. So whether we're talking about it on the federal level, the provincial level, or the municipal level, or the city level here in Canada, it also even comes down to just our neighborhoods and neighbors. So all these different stakeholders either literally have the right or believe they have the right to dictate to us what we can and can't do with our land. And so what that means is if tomorrow all of a sudden you could snap your fingers and start 3D printing houses, well, you may be physically capable of it, but the actual implementation of it would probably get just like, it would get strangled by government red tape, I guess is what I'm trying to say politely. So it's also important that we understand the nature of the reality we live in. And so because of that, it's unlikely that tomorrow, all of a sudden, all the old apartment stock is going to become obsolete. So again, people can talk about, the fractional ownership of real estate through, some sort of cryptocurrency or through Bitcoin or this, that, and the other. And that's interesting. But at the same time, those sorts of new technologies, they're adding a layer on to what we already have. They're not actually completely, destroying what was already in existence there. So this isn't the case where, a landlord isn't at risk the same way that a candle maker was at risk during the evolution of the gas lamp or electricity. So us still as landlords, because we own that underlying real estate and because we then own those boxes on the land, we're in a much better position than a lot of other industries or businesses that could be much more easily disrupted. So that's really the point of that's the point of this whole little historic lesson. Is that making sense to you guys? I hope it does, because at least in my mind, this is crystal clear that real estate has a very deep and wide moat. That's something that you'll hear guys like Charlie Munger or Warren Buffett talk about frequently, is when they're investing in a business, they want to see something that's unlikely to be disrupted. And to me, real estate is a perfect example of that, because we have all these different government stakeholders that are going to slow down any innovation. It's just the nature of government and red tape in general. So let's talk about one of my favorite things about real estate, and that's having control over the investment. So when I'm talking about control over the investment, what I mean is one of the most attractive parts of the real estate investing, proposition is really the fact that we have control over the underlying asset. We can pivot your business model or execute multiple exit strategies when it comes to real estate. Now, when it comes to a stock, we can literally just sell it to someone else. Where when it comes to a real estate investment, we can actually pivot in a lot of different ways. So again, you'll often hear people have the belief that, real estate is illiquid. Real estate's not easily sold. It's not easily as sold as a paper asset like a stock or a mutual fund or things of that nature. But let's actually take a step back. Real estate's actually like a small business. And compared to other businesses, real estate's actually quite liquid. So many have heard that real estate is liquid, but when we compare it to other businesses, real estate is actually, it's quite liquid compared to selling the small business. And you'll find that it's a lot easier to find a buyer for real estate than, say, Subway franchise, your McDonald's franchise, or your Tim Hortons franchise. So what we need to understand is liquidity, how fast we can sell an asset or an investment is actually on a spectrum. It's not binary. Something's not liquid or illiquid. It's more or less liquid or illiquid compared to other investments. So in general, when I'm looking at that spectrum of liquidity in real estate, I think it's actually kind of in the middle. A lot of people present it as if it's on the far right or far left on the illiquid side, when realistically, I see it as in the middle. Sure, things like currency, like cash money, that's the most liquid thing you can probably have in today's society. But like paper, so like stock certificates for publicly traded companies, mutual funds, things of that nature, they definitely have a bigger liquidity, or they're a higher liquid investment because there's a greater buyer pool. But real estate actually has a very large buyer pool as well. It's called the MLS. It's called realtor.ca. So if we ever decide that we need to dispose of our assets, we can always pivot and put it up for sale there. But in addition, real estate has multiple exits and pivots available to us as an investor. So let's talk about, you buy a house. Maybe you bought that house originally just to live in it. So you're like, hey, I'm going to use this house just for a house hack or just for shelter because I need to meet my own physiological needs. So need shelter, need to be protected from the elements. Excellent. Well, at some point in time, you decide that shelter no longer meets your needs or you need to go somewhere else. You can always sell the property. Or we can fix or alter the property and then go and sell it. We can also do things like a vendor take-back mortgage. So we can decide to play the bank, sell the property to someone else, and if, say, they can't get traditional financing, we can choose to finance the property for them. We can do a rent-to-own. We can maybe pivot and start using that property for a short-term rental or put it on Airbnb. We could also just alter the use and re-rent it out. I can take my single-family home, and assuming the zoning's allowed, I can subdivide it and make it a duplex or add a secondary dwelling in my basement. Or maybe I can just refinance the property, pull out some of the equity I have available, and then go use that money to do other business transactions or other investments. So again, when we're looking at paper assets, usually we really just have one exit, and that's go sell it to someone else. Maybe you can borrow against some paper assets some of the time, but compared to the ability to refinance or borrow against real estate, I think that anyone that's being earnest and honest with themselves will agree that real estate, from a small business perspective, is both very liquid as well as has multiple exits and pivots available to it compared to a lot of other businesses. Even if we're comparing this to something like a franchise, a franchise is going to have a lot of rigid systems and rules in place where all of a sudden tomorrow, if your Subway or Tim Hortons franchise isn't doing well for you, you can't necessarily just go and change the menu like that. You actually have to go through an entire process. Whereas a real estate investor, if I put my unit up for rent and no one rents it, well, I can change things very fast. All of a sudden, I can go in there, fix it up, and then try and rent it out. I can go in there and turn it into an Airbnb. I can go in there and just move in myself or move in a family member or a friend. There's a lot of different options available to me. And that's honestly one of the big things that drew me, myself, Matt McKeever, into wanting to become a real estate investor is the fact that I do have some control over the asset and I can influence the returns available. Again, when it comes to a stock, I can't really, especially a publicly traded entity, I should say, I can't really influence it unless I have real influence. Like if I own 10% or more of Coca-Cola, sure, now I can start dictating what Coca-Cola does. But for the average investor, we don't own enough of that asset in order to have control. Whereas a real estate investor, unless we're getting into syndicated deals, we do own enough of that property in order to have direct influence and control over it, so we can implement these different exit strategies or these pivots available to us. So then let's talk about the power of leverage. So when we're talking about the power of leverage, a lot of us will be familiar with the idea that you can borrow when it comes to real estate investing. We can borrow against that investment. And oftentimes here in Canada, we can probably do it at an 80% loan to value. What that means is if we're looking at buying a $100,000 property, we can get a mortgage for $80,000. We only need to come up with $20,000 of that money in order to control that asset. Whereas for most paper assets, unless we're buying on margin, we need a 1-to-1 ratio. So if you're going to buy $20,000 in GICs, well, you now control $20,000 in GICs. So if that GIC in that house is both giving you the same sort of return or growth, let's call it 3%, well, on that $20,000 GIC, you're going to make $600 annually. If we're looking at 3% on that $100,000 house that we now control, well, now we're going to receive $3,000 from the money we invested. This is really simple math, but again, there's a lot of times that I find people just haven't taken the time or energy to sit down and actually think through the process and really understand, why this works the way it does and what the implications are in regards to, say, things like general inflation. So let's talk about how leverage or debt is truly a tool, because it is. It literally is. Way too often I find Canadians especially, they have a lot of drama oriented around debt. They have got a lot of emotions, a lot of feelings, and they're very rarely bringing data. That's why Ben and myself, we're always talking about data, not drama. So if you find yourself being scared of debt, understand that that's coming from an emotional standpoint. That's not coming from your logical brain. That's just an initial reaction you're having in regards to that investment. What we need to do is take a beat and really think things through, because debt's literally just a tool. And like any tool, it can be used to our betterment or our detriment. And it's really up to us and how we use that tool. So when we use debt for real estate investing that generates cash flow, I'd argue that's a really good use of debt. It's earning us a return. Whereas when we use debt for like consumption or lifestyle inflation, well, that's bad debt. Yeah, that's stuff that we don't want. And that's not beneficial to us or our financial futures. So this is what it really comes down to, is understanding that, like any tool, you can use it for good or evil. And what I want to see you guys doing is using that debt for good, taking it and making investments and making things happen with it. So then building upon that, when we're actually looking at that good versus bad debt, what we also need to understand is debt or leverage is a compounding tool. So if our investment strategy is a good idea, then using debt just compounds that good strategy to increase total returns. So if investing in this house back here on this slide was a good idea, then why not buying more houses or controlling a bigger house, all other things being equal? Why wouldn't that be an even better use of our time and energy? Because realistically, time is actually our most limited resource. Way too often people think it's money, but when you actually take a step back and think about it logically and rationally, you'll find that time is truly your most precious resource. So again, referring back to Dan, the Lambo lapdog, when he did his first real estate investment transaction, he didn't buy a single condo. He bought a block of condos. So if I remember the story correct, I think he bought like 13 condos at once. And so he bought those 13 condos at once because in his mind, he thought, well, if I buy one condo, it's a good idea. Why wouldn't it be a good idea to go buy 13 condos? So again, if our fundamental business model is correct, if our fundamental use of debt is good, well, then implementing that strategy on a grander scale, assuming that our business and systems can scale up to that level, well, then that's actually a good idea. And that's how debt or leverage can really be a compounding tool. Rather than buying that one condo all in cash, we can probably go out and at least buy 4 or 5 condos and put 20% down on each of those properties. So as an investor, we can increase our cash on cash returns with leverage. This is something that a lot of the intermediate investors will already be acutely aware of. That's why so many real estate investors will talk about cash on cash returns, rather than simply focusing on ROI, the return on investment. Because with leverage, what actually matters is how much total investment can we control and how can we really maximize our net returns rather than focusing on our returns on investment. So this is an example for me that really sunk home. And this is what I was kind of teasing about, that for some of you that may be more experienced investors, you may be aware of this, but you may have not really ever sat down and really thought through everything here. So let's talk about an example of leverage and inflation. So leverage plus inflation is actually a really cool combo for real estate investors. Let's assume that we buy a property for $500,000 with an 80% loan to value debt. If you guys are in London, Ontario, you can assume that you just bought like a fourplex. If you're in Toronto, you can assume that you bought like the world's smallest condo, the world's smallest pre-construction condo. And let's assume 3% real inflation rate. So because of inflation, our underlying asset appreciates in value in total value, while the cost of our debt decreases. So what this is really talking about is the time value of money. So $1 today, because of inflation, is worth more than $1 tomorrow. So if you have the choice between $1 today or $1 tomorrow, in an inflationary environment, you should always be taking the dollar today, because otherwise that dollar tomorrow is going to be worth less. So in this example, it's decreasing by 3% per year. Or another way to say that is the purchasing power is decreasing 3% per year on the fiat currency. So for a property value of $500,000 times 3% inflation, that's $515,000 or a $15,000 increase. So cool. A lot of us understand that about real estate. In fact, that's why we're very drawn to real estate investing in the first place. But have you ever thought about how that inflation actually impacts the value of your debt? So that $400,000 debt actually decreases in value in real terms or real value every year as well. Because again, remember, $1 today in an inflationary environment is worth more than $1 tomorrow. So what that means is if that debt stayed still, let's say we're not making any principal repayments whatsoever, that $400,000 debt today is the equivalent, so that $400,000 debt today is worth $400,000, but the equivalent a year from now is actually more than that. So what ends up happening is that debt of $400,000 today, if we owe $400,000 a year from now, that debt's really only worth $388,350 in real terms in today's money. Is this clear as mud, guys? Let me know in the comment section if I'm making sense, but I hope I am. Because when I started understanding this, I really started understanding the power behind real estate investing and leverage and why it's such a powerful combo. So over time, assuming inflation, the value of debt in real terms, even without any principal repayment, will decrease over time. Meanwhile, the value of asset in real terms stays stable. So inflation helps leverage investors in a modern fiat currency where inflation is built into the model. It's a no-brainer to use leverage to our advantage. So think about this. When we hear like the Bank of Canada talking about, or like when we hear governments talking about their money supply, or when we hear about federal banks talking about money supply and what they're trying to dial, say, the consumer price index to, and they want inflation to be at 2% or 2.5% or 3% per year, that's literally the government telling you that they plan on making your money worth less tomorrow than it is worth today. So this is literally a basic operating principle of every modern government right now that uses a fiat currency, which is essentially all of them. I'm not aware of any large country that has a resource-backed currency. So what this means is every single major government has built into its entire operating system, into its entire standard operating set of procedures, the idea that money is worth more today than will be worth tomorrow in real terms. They're actively decreasing the purchasing power of your money year over year. What that results in is essentially telling us what their playbook is. And so we know that if we get a bunch of debt today and that debt balance stays the same in nominal terms, that in fact in real terms it's decreasing year over year because of inflation. really hope that made sense, guys. But let's move on now and talk about real estate versus stocks. So when we're talking about real estate versus stocks, this is how my mind works. And we can really treat this the same almost as real estate versus paper assets in general. And paper assets probably is referring to things like GICs, mutual funds, and shares in publicly traded entities. So real estate's actually relatively liquid compared to private shares or illiquid compared to publicly traded shares. So like I said, it's a giant spectrum in regards to liquidity. When we're looking at publicly traded shares, yes, they're very liquid, and private shares are illiquid. When we're talking about direct control of asset, real estate, you're able to pivot the operations or strategy or execute multiple different exit strategies like we mentioned in the previous slides. Whereas when it comes to stocks, we've got no control over the asset. Our only exit strategy is what's called the greater fool theory. Literally, the only way we make money with stocks or paper assets is if there's a greater fool that's willing to pay us more money for that piece of paper. Where when it comes to real estate, we can earn active income from it. Now, some people will argue that with like dividends or paper assets that have distributions, that we do get some cash flow from that. True. But at the same time, we have no control over how those distributions are sent out, how those dividends or when those dividends are paid out. Whereas, again, as a real estate investor, if we don't like the returns that we're currently earning on that asset, we can pivot our strategy and move on to something else, which allows us to earn the type of return we wanted. So again, we can all of a sudden, you don't like the sort of return you're getting on your rental property, switch it to Airbnb, maybe subdivide it, maybe start renting it out by the room, maybe move into it yourself. There's so many different options available to us where we can maximize our returns in order to hit whatever our metrics were for that investment. Where again, with stocks, we don't really have a lot of options available unless you have, say, 10% or more of that publicly traded company. Finally, when it comes to leverage, well, real estate, some of the lowest cost leverage you can get available to you. That inherently of itself should tell you both how governments and banks view real estate. They view it as a very safe asset class. Whereas when we're talking about like stocks and things of that nature, yes, we can sometimes borrow on margin, we can invest on margin, but that's going to be a higher cost debt. And in general, it's less easily available to the average investor than, say, real estate debt. As well, there's a whole industry in real estate focused on private lending, and we've got like, B and C lenders that are going to be a lot more flexible in terms. So again, there's just so many more options available to the average real estate investor in regards to leverage versus stocks. So Diana's saying, I wonder why they do that, devalue everything. That's a whole separate discussion that we can definitely go down that rabbit hole in a second. But the primary driver there simply is it's in their best interest as a government with a paper currency in order to decrease the value so they can go out and print more, which also makes their debt. You remember all those governments with giant amounts of national debt? Well, if they know that that debt's becoming less expensive year over year, it actually makes their business model work better as a government because, they can print more money to then pay off their existing debts. And those existing debts decrease in real terms year over year. So that's it. That's why real estate investing and investing basics 101 for this session. Right after this, we'll jump into some Q&A. So if you guys got any questions either about this presentation or anything in general, feel free to jump in that comment section and start hitting me up with questions. Otherwise, I want to play for you again that amazing video the team put together for the upcoming boot camp. So let's do that.
When they built Cashflow Tribe Canada, I knew it was a go because it was about community. It was about sharing the knowledge and using our unique abilities to be able to create partnerships.
I'm sitting down with Matt McKeever, and if this is what it's doing for a man that has 100 tenants himself and saying that he can grow from this, I said, I need a piece of this. I need to come to this.
Every time I come to something like this, my level of awareness raises. I feel that I can take on a lot more, and my goals have been too low every single time.
Ben taught me to kind of not be afraid to go get it and like be confident with it.
I love how authentic both Ben and Matt are. You can really hear the intention to help us grow to the best of our ability.
This is perfect for people that want to know exactly how to start and what steps to take.
Cashflow Tribe.
All right. So if you guys are interested in checking out Bootcamp, I highly encourage you to do so. I think they're just an amazing experience. That was obviously the dates for the most recent Bootcamp. If you guys are interested in attending our March one in Toronto, it's going to be March 28th and 29th. It's the whole reason why I've started all the different communities I have in the past. I really believe that your network is your net worth, that you're the average of the 5 people you spend the most time with. And the average person isn't surrounded with like-minded individuals. If you want to become a real estate investor, if you aspire to personal development, to self-improvement, to all that stuff, odds are that your friends and family probably have good intentions for you, but they aren't necessarily speaking from a place of counsel versus advice. And this is something we talk about in Cashflow Tribe all the time, the difference between counsel and advice. Counsel is coming from someone that's been there, done that, got the t-shirt. In fact, they're probably still an active practitioner. Counsel is someone that you actively aspire to be. They're currently doing what you want to do, or they've recently done what you want to do. Where advice is coming from someone that's really emotion driven. They're just telling you their thoughts or opinions rather than speaking from a place of experience. So when we create these environments like Cashflow Tribe, whether it be online where we get to teach you every single day here in Cashflow Tribe Alpha, or it's a bootcamp event where we spend an intensive, 2-day weekend together and really just dive deep into limiting beliefs, mindset, and then the tactics and strategies necessary to go out there and crush it as a real estate investor. It's just the energy you get from surrounding yourself with like-minded individuals, people that think the same way as you, people that are the same sort of crazy that you are. There's something really special about that. So if you're looking to surround yourself with people that are the right kind of crazy, you need to come check out Bootcamp. But I see a few comments coming in here, so I'm excited for that. So let's chat. Roberto saying, my wife and I can absolutely recommend that you attend a Bootcamp, Cashflow Tribe. Huh. That's awesome. Appreciate that. And in fact, I think Roberto just tied up a 13-unit multifamily massive burr. So that's going to be a really exciting project. Hopefully we can make some YouTube videos on that too, because I think that would make for an amazing YouTube video. And yeah, he did it as a JV with another person he met at Cashflow Tribe. So I think they need to come up with like a lot of money liquid in the 6-figure range. They didn't necessarily have the money or want to tie up all their liquidity into that one deal. So they were actually able to reach out to a fellow Cashflow Tribe member and come together and create a win-win opportunity. So that's awesome. And also great because Shahir from my team is the wholesaler on the deal. So that truly is a win-win-win. But if you guys got any questions, whether it be about this presentation tonight or general real estate questions, let's dive into it because this presentation went a little bit faster than I was expecting. So we got some time. We got 10, 15, 20 minutes if you guys want to ask some questions. Otherwise, I'm just going to jump over and see what questions we got going on in the Facebook group tonight. Hope everyone's enjoying the week of free content if you're watching this on Facebook or YouTube. So I see a comment here on Facebook. If I'm on my third property and do the BRRRR strategy, can I still go to the big banks? Will they still refinance? So this is a question that I get all the time in regards to real estate investing and the big banks. So will the big banks refinance you on your third BRRRR? The answer is if you fit within their squares, if you fit within their checklist, then absolutely the big banks will do a third BRRRR for you. In fact, my buddy Kellen, who's been on my YouTube channel multiple times now and co-host of the On Fire podcast with myself, he's done like 11 BRRRRs and 10 of them were with one A lender, and that was Scotiabank. So you can absolutely achieve that as a real estate investor. You can get those BRRRRs. The real issue is just going to be, can you will the property's debt service themselves well enough? So what's your total debt service ratio? What's your DSR? Things of that nature is really what holds back a lot of investors when they're trying to do BRRRRs at the big banks. Now, there's a couple other alternatives available to us, right, as well. We don't just need to be going to the big banks. One level, just like a hair below the big banks, is local credit unions. And what's great about local credit unions is they'll build up much more of a relationship with you. They'll even try and get an understanding of exactly what your business model is. And if you have a track record of that, they'll bet or believe in you a little bit more than the banks will, and they'll give you a little bit more leeway as an investor. But then we can also start looking outside of the big banks and credit unions and start going to, smaller banks, independent banks. We can start going to, things like mortgage investment corporations. We can go to private lenders. There's a lot of different opportunities there as a real estate investor. So I think one of the biggest mistakes everyone makes at the start as an investor is thinking that you have to do all your deals through the bank. It's definitely not the case. There's a lot of other options available to us. Stacy here's got a question. Can we have a workshop to learn how to analyze deals? That portion of my education and investing is lacking. Absolutely, Stacy. In fact, this was probably going to be a little bit of a surprise, but we're going to be announcing it either tomorrow or this weekend. We're actually going to be launching, in addition to daily live training, Ben and I are also going to be doing accountability calls twice a week. So Sundays, Ben is going to be doing an accountability call really focused on this, on mindset, on really getting your headspace right, and focused on personal development. And then Mondays or Tuesdays, but I think it's going to be Mondays, I'm going to be teaching an accountability class focused on deal analysis and taking action and making offers. So that call is the call where if you guys have deals that you want to bring to the table that you want me to dive into, then that's going to be available for you guys. That should be starting next Monday. With any new, project or launch we have, there's always a few growing pains. So I know not everyone's been getting the emails about these daily live trainings, but just know we're trying to produce as much content for you guys as possible. We're trying to help everyone level up as a real estate investor because we truly do believe anyone can do this. It's simple, but not easy. So there is hard work involved. Ben and I, we're not trying to sell you a bill of goods. You got to put in the effort. But if you're willing to put in the effort, this is stuff that can be easily understood by the average Canadian. Absolutely. Dave saying, are we able to discuss the layout from beginning to end of a transaction? We can definitely make a course series on that. If you've got general questions, we can definitely cover that. If you guys missed on Tuesday night, Adam Martin did an entire 1-hour training just on the purchase and sale agreement. So that was really focused just on walking you through step by step how the paperwork here works here in Ontario, Canada, in regards to buying a property. And what's great is that paperwork, and that training is applicable whether you're looking at buying an on-market deal or a private deal. So that should help fill at least one of the gaps in the knowledge there, Dave. But we can absolutely look at rolling out a bigger training session just focused on really start to finish the whole real estate process. Kathy saying, do wholesalers ever take offers with conditions of financing? Great question, Kathy. I'm sure there are wholesalers that would consider that, but they're going to be very rare. Because realistically, there's a lot of buyers out there that don't necessarily need financing, or realistically, what I'd recommend doing is if you're looking at buying a deal and you're not positive you can get the financing you would like, what you could look at doing instead is simply, does the deal, still work for you at a 12% or a 14% interest rate? If the deal still works, well, if you've got a pulse and the property is in livable condition, you should absolutely be able to get debt at 12 or 14%. You may not like it. It may really cut into your profit margins. However, that being said, you should still be able to, line up that financing in a short period of time. And then we can always look at converting over into or refinancing into a lower interest rate product down the line. So also sometimes people are thinking they can't buy a property in cash, but they don't realize that if you've got a big home equity line of credit, or if you've got a lot of equity in an existing rental property, you can probably access that through a home equity line of credit or buy again like a second mortgage from a private lender. So there's a handful of different options out there for us. And it's really just a matter of really thinking through, how can I make this work? Rather than feeling like you have to have a financing condition as a buyer when it comes to a wholesale deal, I would first start with, is there a way I can make this work for me? And then try and figure out what those little steps are necessary to make the deal work. Again, let's plan for a worst case of having to pay 12 or 14%. If the deal still works, then you should be able to line up some sort of private financer that can give you like a thumbs up or a written commitment in a very short period of time. And if not, hopefully you've built up your network of like-minded real estate investors where you could borrow the money from them. Andre's asking, can you do a live training on creative financing, possibly a walkthrough of creative VTB offer? Great question. So in fact, starting tomorrow is going to be our financing series. So you guys are going to see me back here tomorrow night. And what I'm going to be teaching you tomorrow night is just an introduction to the different types of lenders and what a lot of their basic requirements will be, their basic requirements and needs are. And then it's a 4-part series. And by the end of it, we're going to be getting into creative deals and creative deal structure and creative financing options. So we got you covered there. We're ahead of the ball on that one. I'm just going to jump over to YouTube quick, see what sort of questions we got going on in YouTube. What's up, YouTube? Hope you guys are enjoying all this great free training. I see Elaine asked, hey, Matt, I came across a house today, wholesale driving around. It's a super nice 2019 turnkey condo that is listed as a rent to own. I was wondering if you'd be able to sublease a rent to own. Would you be able to sublease a rent to own? So you could. I'm not sure exactly what the angle would be there. So in general, rent-to-owns are really focused on retail buyers, and usually those properties are priced accordingly. So oftentimes you'll find a rent-to-own will either have higher interest or a higher purchase price than, say, just a traditional retail property. And that's because, that the operator of the rent-to-own has really put together the full package for the retail buyer. So hopefully that makes sense. Will said, I finally understand. Awesome. I'm glad to hear you got value for that. What do you think about the market in Victoria, BC? So, Mohammed, I'm not super familiar with the market in Victoria, BC. What I like to do when I'm looking at a new real estate market is really just dive into the data. So if I was to try and learn the Victoria market, the very first thing I would do is type in CMHC Victoria vacancy rates. What that's going to do is going to pull up like an entire report from CMHC documenting what the current real estate rental market looks like in Victoria. From that, I'm going to be able to figure out things like exactly what the vacancy rate is, what the average rent is for a bachelor, a 1-bedroom, a 2-bedroom, a 3-bedroom apartment. What I'm also going to want to type in is like Stats Canada, Victoria, BC. I'm going to look at like things like the immigration trends, what's going on there, all those different little puzzle pieces. I'm going to want to gather as much data. So, for example, if you were to ask me what I think about the London, Ontario market, well, because I've studied the data, I can talk from a place of confidence and give you some counsel and say, I think it's a pretty good market. In fact, here in London, we're rocking like a 2% vacancy rate. So that means 98% of residential properties are currently rented out. That's really good. We also are going through a really high increase in rent prices. So right now, there's a lot of demand for our rental units. So we've probably seen a 1-bedroom apartment go from $850, $900 a month, 5 years ago to probably being closer to $1,200 a month today. So because of that, like 25% appreciation in rent, it means that there's still lots of rental units that are under rented that have a lot of value add opportunities. So again, that's a great encouragement for an investor. From an affordability standpoint, I've broken this down on previous live streams, but if minimum wage is $15 an hour and you're working full time, that's 2,000 hours a year. Well, that's $30,000 a year in income you earned. Stats Canada tells me the average Canadian spends about 30 to 40% of their income on shelter. So if I take that, what that means is, the average minimum wage earner in Ontario, Canada, can afford about $10,000 to $12,000 a year on shelter if they're living by themselves. So that means they can afford about $1,000 a month for a 1-bedroom or bachelor apartment. So again, from an affordability standpoint, that makes me feel like because we're able to get 1% rules in London, Ontario that are cash flowing, it seems like a very stable business proposition. So the way I was able to break that down about London is the way you should be able to break down your market of, say, Victoria, BC. If you want to talk more about London, I can tell you about our biggest employer. That's London Health Science Centre. So we've got a bunch of different hospitals here and different research facilities. So we've got like over 21,000 people at London Health Science Centre, making them the largest employer. 2,000 of those jobs are research oriented. If we're talking about not like private employers, then we've got TD Canada Bank. They've got 3,500 employees here. I know a lot of people have the bias thinking that London's very much an auto manufacturing business. But when we actually dive into the numbers, we've got about 30,000 manufacturing jobs. 10,000 of those are auto related. But compared to the digital creative space, digital marketing here in London, I believe, has 9,000 creatives. So we almost have as many creative digital employees as we have auto manufacturing employees. So again, once I started like looking at those numbers and data rather than like the emotions a lot of people and drama a lot of people bring to their analysis of deals, I'm able to dial in and really figure out what's going on in my market. Jump over to Easy Webinar quick. See, okay, still pretty quiet there. What else is going on in the YouTube comment section? Question: in private lending, how does lending of your line of credit affect your credit rating, assuming you're making the monthly minimum payments? Thanks, Matt. So I think next Friday on my YouTube channel, we'll actually have a video coming out talking high level about credit scores and how they're calculated. So, when it comes to credit scores, there's a lot of different factors available there. One thing to be aware of is your credit utilization. So if you've got all the available credit to you maxed out at 100%, that will begin to negatively impact you and your credit score. Now, how much that does is very much a nuanced answer that I won't be able to answer just like on the fly here, but hopefully that gives you kind of a general understanding. Do you know any wholesalers in Scarborough, Ontario? So if you're looking for wholesalers in the GTA, my number one recommendation for you is go out to the Right Club. That's spelled REITE Club. They meet up in Burlington once a month. I think their next meetup is going to be like March 26th. Almost all the major wholesalers in Ontario, Canada, hang out at the Right Club at one point or another. If you're looking for specific recommendations, I'd recommend checking out my boy French Luke on Instagram, and hit him up, join his email list, and really just type in, wholesalers, the city you want to search for, the province you're in, and see what pops up and sign up for every email list that you can get on. Even if you're brand new to real estate investing, I think you can do yourself a huge favor by just signing up for every wholesale list you stumble across, because it's going to give you tons of data points. And the more data we can get, the less drama we're going to have as a real estate investor. And that's what I call a real win-win, is reducing the amount of drama and fear when it comes to investing and really just dialing in the data and facts. Could you provide some direction for those brand new to real estate investing? Ready to dive in, but not sure of the first steps. So my very first recommendation is join Cashflow Tribe. We've got an amazing community. That's what this live stream is all based upon. We're doing daily live training. So if you guys like this training, then absolutely go check out Cashflow Tribe. We've got a free 14-day trial. You guys can join, no obligation. If you decide it's not for you, quit us on the 13th or 14th day. You won't get charged, no hard feelings. I won't take it personally, but you could still binge all of our content up until that point if you wanted to try and get as much information as possible. Otherwise, not sure if you've heard about, but this guy right here's got a YouTube channel, and we've literally got over 600 videos teaching real estate investing on my YouTube channel. Yeah, I know 600 videos is a lot of videos, but think about it. I spent more time making those videos than you're ever going to spend watching them. So if I can afford the time to make those videos, if you're serious about becoming a real estate investor, you can absolutely afford the time to watch all 600 plus of my YouTube videos on real estate investing. Matt McKeever YouTube. Check it out. Beyond that, you can always join Cashflow Tribe. Come out to a bootcamp if you're really looking to get your butt in gear and you want Ben and me to really give you a kick in the arse and get you thinking on a higher level faster. To me, at the end of the day, if you really want to become a real estate investor, if you want to improve, you're going to need to sacrifice something. For some people, that's time and energy. For some people, that's money. For some people, it's a combination of the two. But if there's no sacrifice involved with your commitment to becoming a real estate investor, you will always struggle to take the necessary actions to get the results you want. So until we're willing to sacrifice something, or until we're willing to risk something, we're never going to personally buy into it enough, or 99% of us are not going to buy into it enough to take action. OMG, that's very informative. Thank you. I appreciate that. Would you recommend pre-construction condos? I don't like making blanket statements, but no, I would never recommend pre-construction condos. I know a lot of people decide that they're going to get into pre-construction condos and then try and do assignment deals. Make sure that you really understand that paperwork when it comes to pre-construction condos. I don't know the number of times I've spoken to aspiring investors that were, let's just call it what it is, blatantly lied to by real estate agents that just wanted commission, that told them that the contract they were entering into was assignable, when in fact there was a lot of asterisks and requirements before they were allowed to assign it. So often with pre-construction condos, we don't have a lot of control over that asset. So what we were talking about earlier in today's webinar was all about having control over the real estate investment asset, and why that's one of the big benefits of real estate. Well, in that pre-construction condo contract, odds are you're not able to assign it until the condo's been constructed, or until the condos hit a certain pre-sales measure or some other sort of restriction. And this is very frustrating as an investor, because anything that reduces our options, anything that reduces our pivot strategies, is naturally a hindrance to us and makes our investment less liquid than it otherwise would be. When do you recommend starting to use JV partners, and what do you recommend looking for when sourcing partners? So when it comes to JV partners, in general, I think you need to look at your personality and what your business model is and what you're trying to accomplish as a real estate investor in general. So what's your big goal? For me, I love JV partners because, one, it's just more fun doing it with a partner. So I just like having a JV partner with me because, you know, sometimes buying the next duplex or the next apartment building isn't as personally gratifying for me as it is for my JV partner. So I kind of get to experience it through their eyes and know that that duplex or that $200 a month in cash flow is really moving the needle in their life, where to me, it's maybe more of just another stat to add to the board. Beyond that, you know, when it comes to really scaling our real estate business, at some point in time, we're going to have to start using other people's money. So that can be accomplished through either JV partners or through debt. Those are really our two options for OPM. Now, whether you want to use debt or equity, again, really depends on your business model and what you're trying to accomplish. So there's not a blanket answer that I can give to everyone in regards to when's the right time to start using JVs, and, you know, how, even if you ever should use JVs. But when you're looking to source partners, when you're looking to find partners, go out to networking events and also look in your own personal network. So one, it's great to go to real estate investing networking events and try and find JV partners there. But understand, a lot of those people, they want to become the active partner. So they're maybe not a good fit if you're looking for a passive money partner. Whereas a lot of people that you know that love their day job or would never quit because they're 5 years away from their pension, well, they're a much better target or candidate for becoming a money partner, simply because they fit the profile better. They probably don't want to be an active partner. They probably want to be a passive money partner. They just want that mailbox money that a lot of people talk about when they're thinking about getting into real estate investing. Andrea said, what do you need to look up in order to see if a market in a specific area is good? Example, Kitchener. So we touched upon this already a little bit, but I would look at the CMHC data. I would look at the Stats Canada data. I would look at the local data. And then also we need to dial in neighborhoods. Because again, real estate's all about location, location, location. And location is as specific as our country, our province, our city, but also our neighborhood. It almost should be location, 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 location. There should be 4 locations there, in my opinion. So what you need to do is really understand that microcosm that is that block, that neighborhood, and dial in, you know, what sort of people are moving into that neighborhood, what sort of people are moving out of that neighborhood, what plans are in the future. Has the city got any major infrastructure plans that could either help or hurt our specific area? And really just, it's about aggregating as much information as possible. So there's no moment where you have enough information or not enough information. It's not a binary thing. Again, this is on a spectrum, but in general, the more information you have available to you, the more information asymmetry that's aiding you, the better off you're going to be as an investor. But I'm also acutely aware that a lot of you will use that answer to just have analysis paralysis and never you'll never have enough data, so you'll just always be researching more. Ready, shoot, aim. So really what we need to do is just understand a lot of those big chunks of data that I was just mentioning. And then once we're comfortable in that, network with some local investors there, really get dialed into what's going on the local level, and then pull the trigger. Because again, it's worst case scenario, if you lose a little bit of money on your first real estate deal, don't view that as actually losing money. View that as paying tuition. A lot of us are more than happy to lose $40,000 to $100,000 a year on tuition, or $40,000 to $100,000 over 4 years on tuition to go to a post-secondary institution with no guarantee that that's going to pay off either. So again, if we're getting into a real estate transaction and it's even just a break-even real estate transaction, for example, the first flip I did was actually last year, and we only made $13,000 after everything. So many people roasted me in the comment section about how that wasn't worth it. I'm like, guys, we made $13,000 in 60 days. Still not too bad compared to the average person. And in fact, if you take a step back and also think about, well, I learned a bunch this time, or in this case, my sister and Mike Nowicki learned a bunch that time, that, hey, next time they'll probably even do it better. Next time they'll probably even make a little bit more money. So it's really important that we also understand that this is an iterative process. You're always going to be learning. You're always going to be improving as a real estate investor. When finding private lenders in Tribe or other groups, is it essentially still a mortgage with 25 to 30-year amortization, or can there be a class in a similar scenario? Okay, so we can definitely teach a class on this. But that being said, when it comes to private lending, there are no rules. The only rule is that there's almost no rules. So you can structure it however you want. I've done private financing with 0% interest, no payments for a year. I've done 12% interest only payments. I've done, I think, 16% interest only payments. I've done 4% VTBs for 5 years. So really, there's a giant spectrum when it comes to private financing. That's why so many of us investors are drawn to it, because we can tweak and play with those terms and really dial in the opportunities for ourselves, and really create win-wins, whether it be with the seller or just a private financer in general. So again, don't restrict yourself to thinking in the way banks lend. If you want to do a 100-year amortization with a private lender, if they're down and you're down, you can absolutely do it. If you want to do a 2-year amortization, if they're down and you're down, you can absolutely do it. It really is a lot of beginner investors struggle with private financing because they lack the creativity to be aware of how you can make deals work, when a lot of other investors won't look at it with their creative lenses, and so they'll hold themselves back from actually a lot of great opportunities. All right, I'm going to blast through a couple more questions, and then we're going to wrap up for tonight, but I hope you guys enjoyed this. Have you heard of a wholesaling guru named Max Maxwell, and what do you think of his approach to real estate? So definitely I've heard of Max Maxwell. He's probably one of the most popular wholesalers in the world. I personally haven't consumed a lot of his content, so I can neither say yay or nay. Seems like a pretty authentic guy from everything I've seen, but never met the man myself. And I don't know any students personally. Now, if you're looking to hire a guru, the first thing I would do is try and speak to their students, and don't just necessarily speak to the, affiliate student that gets paid a rip when you talk to them and they sign you up for their coaching class. Talk to real life students that are actually taking action. So join the Facebook groups of those people, Or, you could just check out Cashflow Tribe. 14-day free trial. Also, thank you for all the vids, especially the ones you're doing related to finance, like the credit cards, one specific to Canada. I always watch Graham Stephan's vids and wish someone did them here. Thank you. That means a lot to me because, the credit card videos aren't something that I'm naturally inclined to do, but if I know that they're providing value to the audience, I'm more than happy to keep making them. In fact, every Friday, we're doing kind of like a Finance Friday thing, other than tomorrow, which will be a live training. But we really do just want to provide value to the community we're creating here on YouTube, because we really appreciate everyone's support. So thank you for that comment. Matt, is there any way I can get the current owner to advance me my down payment on closing? Yeah, if you get creative with your financing structure, you can absolutely have an owner advance you your down payment on purchase. Also, just curious, if someone could fully pay for a house, would that be a good investment in terms of gaining rental income? What percentage of return would be a good deal in the GTA area? So, based upon this question, I can just tell you should just do a bunch more learning about real estate investing first. So, buying a house in cash in order to make it a good investment is never a good business plan, at least in my humble opinion. Because again, earlier on this live stream, we were talking about the power of leverage and why leverage is our friend. In fact, why leverage is such an important component for us as real estate investors, because it allows us to own more, control more assets. So no, I would never say buying a house outright just to make it cash flow is a good investment. Would I recommend to be a real estate agent to get an edge? I think becoming a real estate agent, if it's something you're passionate about and would enjoy, absolutely go do it. If you're doing it just as a real estate investor to get an edge, I don't think that there's that good of an edge. I think I have more of an edge by not being a realtor than realtors do by being a realtor. So everyone's telling me I bought too much house for my income. The mortgage will be half my take home, but I feel like even if I need to, I can commute to work and stay with my parents while paying the mortgage. Just wanted the property. It's in a major city on the East Coast, and I know it will be good long term. Well, commenter, it doesn't sound like a good business investment if that's the only way you're going to make it work. Now, what I'd recommend doing is house hacking. Get a couple roommates in there. All of a sudden, it's no longer going to be half of your take-home income. Now, again, it's important that we understand the difference between an emotional purchase, which is our personal residence, and a financial investment, which is a real estate investment. So a lot of people try and convince themselves that buying their principal residence is an investment. I would argue it's not. I would argue it's a personal liability, and there's a cost to that. So I would not view my principal residence, unless I was house hacking or it had multiple units, as a investment vehicle. I would view that as a personal consumption item. So Matt for PM, let's make it happen, but not for a while. I need a long time before that. Give me 15 years, and let's make a run for it. When I'm 20, 35, we'll make a run for PM. Hey, Matt, have you ever heard of a Janice lease? No, I have not. I'll have to research that, Dario. Janice lease. Yeah, never heard of that. Now you kind of got me curious. Okay, I'm going to quickly Google this lease because I've never heard of it before. Lease. Also known as a key money deposit, or key money is a real estate term unique to South Korea that refers to the way apartments are leased. So this sounds like it's very specific to Korea. So no, I've never heard of a key money lease before, but I'll have to figure it out. A renter will make a lump sum deposit on rental space at anywhere from 50 to 80% of the market value instead of paying monthly rent. Oh, okay. Yeah, I've kind of heard of that stuff. Definitely not popular in Canada, to my knowledge. I'm curious to know what real estate markets it happens in and why, because I don't necessarily understand fundamentally why it is. But I suppose maybe in a deflationary environment, it might make sense. I'm not sure. I'd have to actually think that through. Anyways, that feels like enough for tonight. I hope you guys got value from tonight's live training. Just a reminder, we're doing this every single night in March for Cashflow Tribe Alpha members. But everyone watching this in the free beta Facebook group or free on my YouTube channel will continue doing this until Sunday night, at which case you guys are cut off, and then you'll have to join the 14-day free trial. But really appreciate you guys hanging out with me on your Thursday night. And before I let you go, let's wrap it up with a little video. All right, so just do like the commercial said. Check out Cashflow Tribe Alpha. Sign up for your free 14-day trial. I promise you won't regret it. And if you do, just cancel in the first 14 days and you'll be charged nothing. Otherwise, appreciate you guys. Smash the like button. Hit the subscribe button if you're new to my channel. I'll see you tomorrow, and I'll teach you about